The collapse of Silicon Valley Bank last week sparked fears that small and mid-sized regional banks could face similar losses on their bond holdings. Fortunately, most major U.S. banks are in good financial shape. But uninsured deposits, interest rate risks, and potentially large losses on their bonds can all create stress in the banking system. Luckily, regulators and the Federal Reserve have responded swiftly to contain this anxiety. Uninsured deposits. Uninsured deposits are the largest component of a bank's liabilities, accounting for more than 40% of all deposits. They are not evenly distributed across the country, however, according to FDIC data. If a bank goes bust, customers with deposits above the $250,000 FDIC insurance limit can lose their money. The FDIC can liquidate an institution, which dissolves and sells off the failed bank's assets to recoup losses. It can also execute an insured deposit transfer, which sells the failed bank's insured deposits to another institution for a fee. This is a highly risky option because the FDIC is unlikely to be able to recover its costs from selling off assets. It would need to pay out to customers a significant amount of cash, which would ultimately be paid for by taxpayers. There are other resolution methods, though, such as purchase and assumption (P&A) transactions, in which a healthy institution takes over the failed institution before it fails. This usually protects uninsured deposits as well, but it requires a significant outlay of cash. While these alternative solutions might sound better than a failure, they could be costly to the economy and consumers, according to an analysis by Catherine Judge of Columbia University Law School. It's a risky precedent to reset when the economy is vulnerable, she said. A similar situation occurred in the banking industry during the 2008 financial crisis, when large banks like Citigroup C, plus 1.78% and Lehman Brothers LHBC, minus 0.10% were forced into bankruptcy. The government stepped in to rescue these firms by committing hundreds of billions of dollars in emergency funding. But if every uninsured customer bolted from a bank, it would quickly run out of funds to cover their deposits. That's a very serious problem for banks, says Daniel Seru, director of the Economic and Policy Analysis Group at the Federal Reserve. The two banks that went bankrupt last week had high proportions of uninsured deposits. The majority of Silicon Valley Bank's balances and 90% of Signature Banks were uninsured. For that reason, a failure of a bank with high uninsured deposits is a very serious threat to the economy. As a result, regulators have made an exception for the two failed banks and are in the process of paying depositors back in full. It's a strong sign that they won't allow a repeat of the events that led to the financial crisis, but it's unclear how much it will cost the economy in the long run. Unrealized losses. In a recent study, researchers found that the average regional bank has lost 10% of its value in the past year. This is because interest rates have slashed the value of banks' loan and securities portfolios. These reductions in fair market values have attracted the attention of credit rating agencies, which have downgraded many regional banks. As a result, many regional and mid-sized banks have accumulated massive unrealized losses. These losses are not included in their balance sheets or income statements, but they do add to liquidity and capital risks that they face. However, unlike fair value losses, which directly affect shareholders' equity, unrealized losses do not necessarily add to regulatory capital ratios of U.S. global systemically important banks or Northern Trust Corp. But as unrealized losses pile up, they also weaken a bank's buffers that regulators use to protect customers from future shocks. This can lead to a collapse of banks when the losses are realized, which could trigger bank runs and put more money at risk. These unrealized losses are estimated to be as high as $1.7 trillion by the end of 2022, according to a recent paper from researchers at New York University. This would represent almost as much as banks' total equity of $2.1 trillion, the authors said. This amount of losses is enough to wipe out a bank's capital buffers, which are meant to protect depositors from loss. The thinner a bank's capital buffers, the higher the risks that depositors and investors will take in their deposits, according to Fitch Ratings. Those worries have intensified in the wake of the failures at Silicon Valley Bank and Bank of America, which had huge deposits from the tech industry. Analysts say that SVB made a series of fatal mistakes in its risk management, including failing to hire an official chief risk officer for 8 months before the bank collapsed. These errors, combined with the bank's large holdings of mortgage-backed securities and the rise in interest rates, led to a run on the bank that forced it to sell those assets at a $2.4 billion loss. This led to a crisis that has prompted government agencies to take emergency measures to backstop the financial system. Leverage. Leverage can be a powerful tool for businesses and investors, but it comes with risks. It can help you make bigger profits, but it can also make it harder to get out of debt if you lose money. This is why leverage should be used only by seasoned professionals who can afford to lose money. A coin flip might not seem like a high-risk investment, but when you borrow $4,900 to buy $10,000 worth of chips and then lose the flip, you have to pay back that debt. It's similar to using debt to invest in a business that would otherwise be too expensive. But leverage can also work in your favor if you have a lot of cash to invest in assets and are confident the investment will pay off in the long run. It's a way to take advantage of economies of scale, such as buying multiple properties or building up credit lines. However, it's important to remember that all investments carry risk. Financial leverage magnifies this risk, which can make it difficult for people and companies to recover from losses. It can also reduce the amount of available funds until the debt is paid off. As such, financial leverage can be a good tool for companies that are experiencing growth and need additional capital. It can also be a way to expand an existing business without breaking the bank. This type of leverage can help a business to buy new equipment, technology, or real estate that it wouldn't have been able to afford if it didn't borrow money. But leverage can also put your business at a greater risk of bankruptcy and can be used only by experienced entrepreneurs who can handle the potential for losses. Another example of leverage is when a company buys stock in itself. This is a risky move, but it can be helpful if a company has enough cash to buy the shares and the price rises. But when the market value of a company's shares falls, it can cause the firm to go under. This is what happened with Silicon Valley Bank, SVB, and Signature Bank, which both collapsed last week. In addition, a large number of regional banks in the US have been hit by the crisis. Several have been taken over by regulators and are under pressure to raise more capital from investors. This has resulted in a rush of deposits into some of them, as well as a flight of customers. Assets. The collapse of Silicon Valley Bank has shaken the global financial markets and sent shares of almost every bank down. It is the largest failure of a U.S. bank since Washington Mutual failed at the height of the GFC in 2008. Although it is hard to know exactly what caused SVB's failure, one thing that seems certain is that the Federal Reserve has made some very bad decisions over the past few years. During the last decade, the Fed has aggressively hiked interest rates, making bonds that are deemed to be safe, such as Treasury notes, lose value. SVB was especially vulnerable to the rising interest rates because it had heavily invested in government bonds. It lost $1.8 billion on the sale of those bonds, causing a panic among its depositors and ultimately bringing it down. As a result, it was forced to sell its highly liquid assets to pay off its depositors, which cost the bank billions of dollars. The Federal Reserve has now taken measures to try to prevent another collapse, including creating a special emergency lending facility for banks that have loaded up on low-quality bonds that have fallen in price. While it is not clear if the Federal Reserve will be able to create a solution that will prevent the collapse of any other bank, several politicians have called on the central bank to backstop all deposits in U.S. banks to prevent runs from customers. Currently, about a third of all assets in the banking system are held by smaller banks with uninsured deposits. That means that these banks will have to tighten up their lending in order to raise capital, which is a major problem. But what if half of those uninsured deposits were to be withdrawn? That would leave 190 of America's banks facing losses of up to $300 billion, according to a new study. That could mean that many banks with uninsured depositors might need to be taken over by the FDIC, or forced to spend billions of dollars to cover insured deposits. That is not just bad news for the banks, but for their customers and investors.